Good afternoon and welcome to the latest in our series of webinars with ActivTrades. Thank you for taking the time out of your day to join us this afternoon. We're going to look at the 6 days of Christmas, a little bit of a play on that well-known festive song, the 12 days of Christmas. And we're going to take a look at 6 macroeconomic events that are coming up between now and the holidays. I'm Darren Sinden. If you haven't sat in on one of my webinars before, I'm an independent market analyst and commentator, been in the industry since the mid-80s. And these days, as I say, I write independent analysis and market commentary and try and mentor people who are learning to trade and want to improve their trading outcomes and abilities. And try and do that in a straightforward fashion as possible, using freely available resources and information from around the internet and beyond. So without further ado, it's Thanksgiving today, hence the US flag and the Statue of Liberty. And we've got 6 key macroeconomic events in the run-up to the festive period, which really starts here as far as the Americans are concerned. These are separate events, and one can treat them like that, though they are intrinsically linked to each other, and we'll see how some of that linkage appears in the rest of the slides, I guess. Okay, so the first of our key macroeconomic events kicks off tomorrow, not technically in December, but as I say, it does really mark the start of holiday season in the US, and that is Black Friday, November the 25th this year. So Black Friday is a colloquial term, a slang term, if you will, for the Friday after Thanksgiving, and it traditionally marks the start of the Christmas shopping season in the United States. So why is one particular Friday so important in the as far as retail is concerned, and as far as the year's economic calendar? Well, just think about this stat to begin with, that the US consumer is responsible for as much as 70% of US GDP, or gross domestic product, via their personal consumption and expenditure, or PCE. So what happens to the US consumer very much matters to the US economy at large, and that it follows that when consumers are happy and healthy and spending money, the US economy is doing well. But when that isn't the case, then the US economy can suffer as a result, and usually does. Okay, so let's look at some more Black Friday stats and just get a feel for why it's such an important day. So the first of our little graphics here takes a look at Black Friday performance and stats from 2019 versus 2020. And obviously, in the middle of that, we had COVID. So just to sort of exemplify what sort of numbers we're talking about, in 2019, Black Friday revenues were $142.4 billion. For 2020, and remember, we were pretty much coming out of lockdown here, and well, in the UK, just about to go into another one, in fact, but projected revenues were $184 billion, but in the end, US retailers took $188.2 billion in actual revenue. Black Friday, interestingly, is still a physical thing. Footfall. People do go to the shops. We saw in our previous slide pictures of crowded shopping malls and stores, and it's very much the case that that US shoppers do still attend physical locations, bricks and mortar retailers, if you will. However, we'll see online shopping is going rapidly. So just to give you a feel of the difference in scale, as we said, 2020 revenues for retailers on Black Friday were $188.2 billion. For the same period, $9 billion was spent on online shopping. So, a considerable factor of 20 basically is the difference. But online shopping is growing rapidly, as we can see here, and the growth between 2019 and 2020 was 22% year over year. It will be interesting to see if, as the economy, I say if, but as the economy has returned to normal now, or some sort of normality, what that sort of growth number will be. Anyway, who has been the beneficiary of that growth in online sales? Well, the biggest winner, in terms at least of market share, has been Amazon, and they typically represent around 24.2% of online sales among major retailers on Black Friday. However, that hasn't really benefited their share price. Amazon is down more than 40% year to date, and so we'll come to that a bit later. But it's not that market share is not necessarily feeding through into a positive share price performance for Amazon. The boundaries are blurring between bricks and mortar and online retailers as the bricks and mortar guys look to grow their online share. Best Buy, of course, is a US electricals retailer and well known for large discounts on things like plasmas, flat screen tellies, etc. over Black Friday. But other more sort of day-to-day retailers, more general retailers, are growing their online share as well. Walmart, I picked out here, around about 4.6% of all Black Friday online sales are accrued by Walmart. Interestingly, their share price has risen by 11.4% in the last month and by 24% over the last 6 months. And they've really been leading the pack among bricks and mortar retailers in terms of adjusting to the new economic climate. They had numbers recently which were very well received, hence the 11% rally in the last month. They are, of course, the world's biggest retailer, more of an oil tanker than a speedboat. Takes a long time to turn them around, but when they do get it right, the gearing's there and they really do suck up the dollars. Okay, so what sort of areas can we be looking at around the Black Friday numbers? We won't really find out how stores have done until the early part of next week. And of course, on Monday, after the weekend, we have what's known as Cyber Monday. That's the day traditionally or historically in America where most money is spent online. And we'll probably find out about footfall and indications of sales from the major retailers Tuesday, Wednesday. Chart I've drawn here is of the S&P 500 consumer discretionary sector. I like to think of the consumer discretionary sector as the sectors that sell us things that perhaps we don't know we don't need to actually survive day to day. That's where we spend our spare cash typically. That line, or the consumer discretionary sector rather, is the black line here. As you can see, over the 2-year period that I've drawn this chart, that sector has fallen by around 14.36%. But I've contrasted the sector performance with that of Amazon here in green. Amazon isn't actually in the consumer discretionary sector, just to be clear. It's in an internet technology-related sector, but nonetheless, as we've seen, it's one of the biggest online retailers in the States, so it does seem appropriate to plot it against the sector here. And as we already discussed, Amazon down over 40% over the last 6 months. Now, what do I think that means? Well, I think Amazon being so oversold, underperforming, call it what you will, could benefit from any good news about Black Friday and Cyber Monday sales data. So I think that's something to look at. But I'd also say that I don't think the consumer discretionary stocks are pricing in any bad, they are pricing in bad news, what I mean to say, and they are not expecting anything good from this weekend. Why do I say that? Well, the sector did have a run. Here's a table of the new period highs that it's made, and over the last 6 months, it's printed new highs 17 times. But right now, or as of the close yesterday, the sector was 20.6% below its prior 6-month high. So it's had a run, and as we can see, if we look back to the early part of the year, yes, it ran up, but it's sold off pretty much since then. So I think good news again could be good news for that sector. Having said that, having had that downturn, most of the stocks within it are happy to stay above their period moving averages. I mean, we've got 85% of consumer discretionary stocks above their 50-day moving average, 75% above the 100-day, and even 60% of the stocks within the sector above the 200-day average. So down but not out. but potentially likely to respond well to good news on consumer spending over this period. Though I have to say, I'm not convinced that that's what we'll see, but that's what makes this such an interesting period. Okay, well, moving on from Black Friday, Cyber Monday, and footfall across US shopping malls and clicks on keyboards and mouses. On December the 2nd, we have perhaps, I would say, the most important number for 2022. It's the last non-farm payrolls figure, the US unemployment situation report, and in this case, of course, it's for November 2022. What can we expect to see? Well, may have just had a clue from the initial jobless claims, which were out early in the week, and they rose slightly. So more people claiming for unemployment for the first time. We had been trending obviously lower post-COVID. We saw a brief blip over the summer, probably a bit of seasonality there. Claims fell again into the early autumn, but they are just rising now, and maybe there's something in that. But let's have a look at some other charts and get a bigger picture of what we might expect. So in terms of the payrolls data itself, that's been trending lower really since February. So pretty much the start of the year, we saw a big jump up in February to 714,000 new jobs created. But ever since then, we've been printing lower figures. We did see a spike higher at the beginning of the summer with the July data, 537,000 new jobs created then. But since then, we've had 292,000, 315, 261. And expectations for the November number are somewhere between 200 and 210,000. So you could take that to suggest that the labour market is slowing down slightly. And indeed, you could also infer that, or to try and confirm that, from this chart here, which shows us average hourly earnings. That's one of the components of the overall non-farm payrolls report. And again, having peaked in the early part of the year, touching up to sort of 5.6% increase in hourly earnings, we've been dipping off since then. And in fact, since the summer, the figure has been trending lower and lower. So that's something to watch. On top of the outright job creation number, hourly earnings, what's happening there, because that says quite a bit about the tightness or slackness in the labour market, which again, as we'll see later on, could feed back into inflation. Now, the unemployment rate is also reported alongside the job creation rate. And again, this is a key number to watch out for. If we're talking about the kind of levels that some market commentators are talking about and would like to see unemployment get to allow the Fed to get back to its 2% inflation target, people are saying that unemployment around 6% should allow that to happen in the US, and that would dampen demand and keep wages in check, which of course we can see is probably already happening to some extent here. But we're not there yet. But what we are seeing, having dipped quite strongly post-COVID, it does look now as though unemployment could be bottoming out just below 4%, and perhaps just hinting about heading higher. In terms of what people are looking for, in the unemployment rate prior, as I say, 3.7%. The consensus forecast for the November data is for 3.8%. So perhaps a smidgen higher. That would probably be well received by equity markets if unemployment did drift up, because that would suggest that there's less pressure, less inflationary pressure in the US jobs market, and therefore that the Fed could perhaps slow the path of interest rate rises and dare I say it, take its foot off the gas as far as sticking interest rates higher is concerned. Looking at the last chart on this slide, job openings in the US, the number of unfilled job vacancies there are in the States. These numbers always make me wince. They're so huge. We peaked recently in July, in fact, at just over 12,140,000 unfilled job vacancies in the US. That has been declining. It's drifted down, or it did drift down into August to around 10,389,000. Peaked again in September to 10,695, but that's still on a lower trend. And one would like to think perhaps that the jobs market is, again, as I say, exhibiting a certain amount of slackness. We've obviously seen technology companies in the US start to trim headcount over recent weeks. They were obviously over ambitious in terms of their recruiting, and they're now trying to right size their businesses, and that would, that could easily account for the decrease in available vacancies. Before firing people, of course, employers will typically look to reduce hiring. Right, well, let's press on to our next slide. And 2 days after the non-farm payrolls, OPEC meets in Vienna. Normally, OPEC would meet at the end of November, but it's been pushed forward into December for this year. Of course, energy prices and the demand for energy have really been the key economic factor, I would say, during 2022. Yes, rising US interest rates have also sort of hogged the limelight to some extent, but with Russia's invasion of the Ukraine, energy has been front and center, particularly in Europe, and remains so, of course, as we enter into the coldest part of the year. Oil prices themselves have actually been falling, particularly over the second half of the year. We saw very much a strong rally in oil. This is WTI crude, but it doesn't want to go, or didn't want to go above $120 a barrel, even when Russia was making its troop build-ups on the Ukrainian border and finally invaded. And to some extent, it was a case of buy the rumor, sell the fact in WTI over that period. And since then, we sort of first of all drifted sideways with another run up in early May. We peaked again here at around $117 and have sold off since then. And in fact, WTI has fallen by 30% since that period. So in the last 6 months, West Texas Intermediate crude has come down by 30%, suggesting that perhaps, again, there is a bit of slack, a bit of extra capacity in the oil market. And that's a function of two things. Firstly, there was rather some increased production in the preceding sort of 6 months to try and counter the sort of embargoes and things with Russia. And secondly, of course, people are talking about slowing global growth, particularly in China, which is still subject, of course, to a number of COVID restrictions, and in fact more likely to be imposed in the coming days. Well, that takes quite a significant chunk of global demand out of the equation. Demand per se, because obviously China still wants and needs oil, but it's that marginal demand for oil, the extra demand for oil that comes out of the system, creating a bit of slack, creating a bit of excess supply. Now, OPEC was recently rumoured a couple of days ago to be considering an increase in production of some 500,000 barrels of oil per day. That move was said to be led by Saudi Arabia, one of the world's largest oil producers and probably the leading light in OPEC. And it was said to be being mooted with a view to meeting any shortfall caused by further EU restrictions on Russian oil exports, which are likely to come in to effect on the 5th of December. So the OPEC delegates could well be discussing that just a day before the EU restrictions come into effect. Whether or not restrictions from the EU actually keeps Russian oil out of the market is a bit debatable, because there seem to be a number of backdoors through which Russian oil can flow. It only needs to be blended with a modicum of oil from somewhere else, some other exporting country, and it doesn't then constitute Russian oil anymore, is my understanding. Nonetheless, talk of a further 500,000 barrels per day into the market saw oil sell off once more. The Saudis have actually now denied that increase was ever going to be suggested or ever going to be discussed at the OPEC meeting. We'll know more about that, of course, when we get nearer to it. The last thing that OPEC did, or OPEC and its allies known as OPEC Plus, was to agree to trim production by up to 2 million barrels per day, and that decision was reached just over a month ago. So it does seem slightly unlikely that the Saudis would now want to increase production, but let's not try and second guess them. Now, much has been made, of course, about the emergence of America, the USA, as an oil producing and exporting country, and that is an important point to make. America, in theory, could be self-sufficient in oil and gas. However, it's not a huge exporter. Much of the oil and gas that it does produce is consumed, or most of the oil and gas it does produce is consumed at home. That is changing, but even as we reach the end of 2021, the Americans were only exporting around 7.27 million barrels of oil per day, whereas OPEC share of oil exports as a whole was around 47.68 of global world exports, much bigger than the rest of the world combined. So what OPEC says and decides to do really does matter. There was a time when they didn't count for much after that period where they went to war with the Russians, and the price of oil, as you'll recall, fell into negative territory. But more recent developments have put OPEC front and center again, and so we should be paying attention to what happens in Vienna from December the 4th onwards. And of course, the obvious thing to be trading here is crude oil itself and or crude oil equities. Don't forget that BP and Shell, the two largest UK companies, have been that pretty much make up the FTSE 100 UK oil and gas sector, have been amongst the best performing assets in the world over the course of 2022 to date. Now, oil prices may have been heading lower, but the cost of shipping that oil is still rising. So the actual headline price of oil isn't necessarily the only consideration in terms of what we as consumers are paying for oil. And as we can see here, again, since May, interestingly, since prices started to sell off, the cost of moving oil around the world in tankers, and that's in three classes of boats: the very large crude carriers that are the biggest oil tankers in the world, the Suez Max class. Those are the boats that could just about squeeze through the Suez Canal. The very large crude carriers typically can't go through it because they're too large. And then Aframax carriers that make the journey from the Red Sea and the Persian Gulf around the coast of Africa and into the Atlantic and onto their markets in the US and Europe. But as you can see, for all three classes of tanker, prices have been rising and rising quite steadily. They don't show any signs of slowing down at the moment either. Maybe that's a sign that demand is still in the market, that all cargoes are still being bought forward. But that's something else that we can keep an eye on post the OPEC meeting and into the first quarter of the new year. Okay, so after we hear from OPEC and we find news about what their goals for production are going forward into Christmas and into the first quarter of 2023, On the 13th of December, we will have US inflation data. Again, this is a data point for November. Again, we know the story. We come out of COVID. We can see it here on our first chart. Inflation had taken a dip, of course, into the lockdown period. Demand slumped. We all stayed at home, and so prices fell. But of course, once the global economy was reopened, there was a tremendous amount of pent-up demand. It wasn't necessarily excess demand, but it was demand that hadn't been fulfilled, for periods of 3 or 6 months, and that hit the global economy all at once, as it were. We all wanted to get out, spend money, do things, treat ourselves, buy stuff we hadn't been able to buy while we were in lockdown. And we know the net result of that. Inflation rallied strongly, peaking in early 2022. Since then, inflation in the US has been dipping. And I've said here a possible peak. I think for the moment, I think we can probably conclude that is the peak of US inflation, at just above 9%. But it's not quite as straightforward as that, because there's a 2-speed decline, if I can put it like that. And on our second chart, I plotted the rate of inflation here in blue against the core rate of inflation, so ex-food and fuel. And as we can see, the dotted line, which represents the core rate of inflation in the US, is somewhat stickier and falling rather more slowly than the blue line for the headline rate of inflation. So whilst the headline number's down, the core inflation rate, which is what the Fed really looks at when it's making decisions about interest rates that are based on inflation, is proving somewhat stickier. In terms of what we can expect from the inflation data on the 13th of December, core inflation on a year-over-year basis came in last time out at 6.3%. The forecast for November data is for something around 6.2%. And for the headline rate of inflation, last time out we were 7.7%. This time out we're looking for something around 7.6%. If we see a bigger dip in either of those two numbers, I think that again will be taken very positively by equity markets, particularly stocks which are high beta and risk on, and that would typically mean the Nasdaq 100. I would suggest. Of course, any move higher will have exactly the opposite effect. It's quite binary, probably, the effect on risk assets. If inflation ticks up, then the expectation will be that the Fed won't be able to take its foot off the gas in terms of interest rates, and therefore higher for longer. And that's the worst for technology stocks, which are not seen as doing well and don't do well in a rising interest rate environment. You'll of course recall that we saw that Amazon was down 40-odd% over the last 6 months, when of course interest rates in the US have been rising. So here's a few more charts just to sort of exemplify what is happening with inflation, and it's a bit of a mixed picture. Now, US diesel prices have remained elevated throughout the post-COVID period, but unfortunately they've been picking up even more in 2022. Now, it's not just consumers that are affected by this, because diesel powers the majority of US freight transport, whether that's stuff that's taken by diesel-powered trains, whether it's hauled across country on large lorries, or as is also quite common, shipped down large rivers like the Mississippi and the Missouri on diesel-powered barges. And so a high diesel price and a rising diesel price is a bit of a bugbear for inflation. Now, interestingly, against that, energy prices in the US over the second half of this year have actually taken a big dip. Again, we peaked in May and June, and since then energy prices have fallen, and that will have a knock-on effect potentially, as we'll see a bit later on. The good news as well, as far as US consumers are concerned, is that food inflation again looks to have peaked in the middle of this year. This is a bit of a lagging indicator, but nonetheless we can see an end to the rising trend there in food inflation in sort of July, August, and maybe that's a good omen. It certainly seems as though US consumers are taking some of these peaks and then latter dips to heart. The last chart here on this slide is a chart of consumer inflation expectations. So what do US consumers think will happen to inflation over the coming year? And having seen expectations peak in June at around 6.8%, consumers now think that it will dip to around 5.9%. Now that was a data point for November. Again, it's a lagging indicator, but it's the trend here that's important, because if US consumers believe inflation is moderating, then they're likely to spend more, which again, as we saw earlier, will be beneficial or potentially beneficial to the wider US economy. Now, our last slide on inflation is quite an important one, and will feed directly into our next section. But I just want to point out that oil prices are very closely tied to expectations about inflation in the US. And it's not just in the minds of consumers, but very much in the minds of the market. And so this chart, which is taken from the Atlanta Fed, St. Louis Fed, Fred charting system, is a very interesting one. It plots the 5-year break-even inflation rate, which is the bond market's expectations of where inflation rates will be in 5 years' time, and that's the line in blue. And it plots that against the price of WTI crude in red. And as we can see, inflation expectations peaked in March or April of this year in the US, and as far as the bond market's concerned anyway, and they have been trending lower. They did peak or start to rally again in October. Once more, we're back into a downtrend, and I think we can say that there's a loose correlation here, reasonable correlation between where oil prices are heading and where the bond market's expectations for inflation over the next 5 years are heading to. Now, what's interesting is that we've dipped back into the sort of territory with inflation expectations that will please the Fed, and that's around 2.35%, and that's much closer to the Fed's 2% target than the peak figures of almost 3.6% that we saw in March and April this year. So when the Fed talks about regaining their 2% inflation target, that might sound illusory with inflation still above 7% in the US at a headline level. But as we can see over the medium term, the markets believe it is possible for us to get somewhere near to that figure. Speaking of the Fed then, on the 14th, the day after the November inflation figures, the FOMC meets, the Federal Open Markets Committee meets in Washington to decide on interest rates, the last interest rate meeting of the year. And it's a bit of a mixed bag as to what we can expect. Now, I don't think that the November inflation release will make any difference to what the Fed decides. They'll have an insight into what those numbers contain well ahead of the rest of the market by virtue of where they sit. And the committee members will have made up their mind, largely made up their mind long before they gathered together to formally announce their interest rate decision. Now, in terms of what the market's expecting from the November meeting, we're expecting a rate rise, but not a 75 basis point or 0.75% rise. A 0.5% rise is priced in by the markets for this meeting. This is the Fed Fund Futures probabilities chart. This is compiled by the Chicago Mercantile Exchange, the CME, I should say. And if you want to follow this, just look up CME Fed Watch, and you can see these for yourselves. So it's a very useful tool. You get a countdown to when the next meeting is, and you get a a chart and table of the probabilities what Fed fund futures think will happen at that particular meeting. This is for December, but if you look across the top, you can see Feb 23, March 23, all the way out to December next year. So at the moment, the market's expecting, or 3.64%, let's call it, of Fed fund futures traders are expecting a 0.5% rate rise in the US from December. However, the certainty about that has been wavering lately. And we can tell that by looking over here. And this is the sort of percentage of traders or positions that traders have. They're expecting a larger 75 basis point or 0.75% basis rate rise. Now that figure stands at, say, just over 36%, still in the minority. But what I think is interesting is that it has been creeping up. Now, a month ago, you would have got even money basically on a 75 basis point rise. That's fallen away, and it fell away to just under 20% a week ago. But in the last week, it's been picking up. 23rd of November, the percentage traders expecting a 75 basis point rise was just 24%. But today, or as of the close last night, in these Fed fund futures, it's crept up to 36%. Now that's interesting because we had the Fed minutes for the November meeting last night, and that basically hinted at smaller rises going forward. Whether we get that smaller rate rise in December, or whether that's something for the new year, is perhaps what the market's feeling somewhat nervous about. 50 basis points or lower will be positive for equity markets, but anything higher than that would be very much a disappointment, and one would expect equity markets to sell off if that were to prove to be the case. Now, it's not just a cut and dried decision for the Fed. They will want to consider all sorts of data, and one question that they will be asking themselves is the US economy slowing? Why do they want the US economy to slow? They don't, but they do want inflation to be curbed. They can't do much about the supply side of the equation on inflation. What they can try and do is limit or cap demand in the US economy, and to try and head inflation off at the pass in that regard. And so they are interested in what is coming out of the US economy. GDP, for the most part, is a lagging indicator, so that's not something that the Fed will immediately be looking at. But what it perhaps will pay more attention to is economic activity within the US economy now. And one tool to measure that would be PMIs, or Purchasing Managers Indexes, surveys which are carried out on a monthly basis, which take in people who are investing and spending money in a large number of US companies. And basically, the PMI survey asks them a regular set of questions about what their spending outlook is, what they're likely to do about hiring, capital investment, et cetera, et cetera. We had data for that on Wednesday. We had manufacturing, services and composite PMI from the States. And we had forecasts here on the right-hand side. Rather tellingly, all three data points came in well below forecast. In the case of services and composite, the best part of 3 percentage points below those numbers. And even in the case of manufacturing in the US, about 2.5 percentage points below the expectation. So that's quite a significant dip, and it wasn't anticipated. But it does suggest that perhaps the US economy is cooling, and that the action the Fed has taken to date is working. Whether that will persuade the Fed to continue to raise interest rates, then obviously we know they're going to raise rates in December, but whether that will extend into the new year is perhaps the question on the mind of most investors. But also, how low will the manufacturing, services and composite PMI for the US descend? Because readings below 50, and we've plotted a chart here that show the trend in those three indicators, readings below 50, which is where this grey dashed line is, they indicate a contraction or recessionary behavior in the US economy. Now, the Fed wants to slow the US economy to head inflation off at the pass, but it wants to do so without damaging the economy if it can. A deep-seated, long-lasting recession would indeed damage the economy. A temporary dip below the gain line in economic activity for the PMIs might not necessarily be the worst if we don't sort of, well, fall off a cliff, if I can put it like that. And so, what of GDP and the sort of the longer term indicator for the US economy? Well, as I said, standard GDP measures are typically backward looking. They're looking at what happened in the quarter just gone, rather than telling us anything about what's happening currently and in the future, as the PMIs do. But the Atlanta Fed runs a very interesting model, what it calls a nowcast model. GDP now, in fact, is the name of the product, and that tries to estimate where US GDP will come in the current quarter. So we're in Q4, obviously, of 2022. The Atlanta Fed looks at 13 high-frequency leading indicators to make its judgment, and at the minute, and obviously we've still got 5-6 weeks to go in the quarter, but at the minute, the Atlanta Fed estimate is somewhere around 4% on an annualized basis for US GDP for Q4. Now that would be a phenomenal result, because if we look at where Wall Street's consensus is and the average of the Wall Street consensus, well, we're thinking, or they're thinking, that the US economy is only likely to grow by around 0.5%, so pretty stagnant. The reality is that the Atlanta Fed number is probably going to be trimmed as we move closer to the data point, but not necessarily by the full 3.5 points that it's and more that it's suggesting the US economy could grow. So just keep an eye on what that figure's saying over the coming weeks and months, because the nowcast can be accurate. It is looking at, as I say, at leading indicators rather than lagging indicators, and so there may be a growth surprise in Q4 GDP, which of course might stay the Fed's hand in terms of taking its foot off the gas. So as you can see, what happened in the US economy affects consumers, affects the price of oil, affects the Fed's thinking around interest rates, affects the rate of inflation. Now, our final indicator of note before we start winding down for Christmas comes on the 15th of December in the shape of US retail sales, and of course that takes us back full circle to the beginning of the slides when we were talking about Black Friday and the US consumer. Now, interestingly, one of the things that the Atlanta Fed looks at when it's compiling its GDP nowcast about real growth in the US economy is consumer spending, or personal consumption and expenditure, which, if you recall, I said earlier, makes up 70% of US GDP. So it's probably one of the most important economic indicators in the US. It's represented here in this chart by the purple bar. And as we go through the year, we can see that it hasn't actually been declining at all. In fact, it's actually been expanding. And so according to this data anyway, up until the middle of November, US consumers have actually been spending more money, been consuming more goods, and have been keeping their end up of the US economy. If we look to the graph or charts on the right-hand side, I've just tried to set the stool out clearly so you can see what's happening. We've got 4 consumer-related indicators here, starting with the US consumer confidence. Now, consumer confidence has actually been falling over the course of this year, peaked in the summer of 2021, and since then it's been trending lower, although interestingly we've not seen that reflected, as we can see on the left hand chart, in terms of the PCE measured by and consumer spending measured by the Atlanta Fed. In terms of retail sales, they've been pretty flat and moving sideways. This is the yellow line throughout the course of 2022, but maybe they're just starting to peak up again. Slightly lagging indicator. We're a month behind. The data we'll get on the 15th of December will be for November, but you can see the faint suggestion of an uptrend there. Disposable income, of course, how much money US consumers have to spend might be thought to be an indicator of where retail sales might be heading, and indeed they've started to pick up. Well, it picked up in Jan 22, and they've continued to trend higher since then. The final line on our chart is US consumer spending. Again, this is a lagging indicator, but again we can see picking up after the end of COVID, and then continuing to drive higher, and that must be the hope of retailers heading into Black Friday, that uptrend will continue, and that this uptick in US personal income will find its way into their tills. So plenty to think about there. Again, those discretionary consumer discretionary stocks that we looked at the beginning of the presentation will be the ones to look at trading on the back of this number. In terms of what we can expect from retail sales data, we're looking for 1% growth against for November, against a previous growth rate in October of 1.3%. So anything above 1%, and ideally something closer to 1.3% will probably be a win-win as far as the retail stocks are concerned. Of course, as we saw earlier, it will largely depend on where and when and how consumers spend their money. Walmart, as we said, probably the potential winner over Black Friday, but Amazon poised and the wider sector poised to do well if the US consumer comes out in force. Call it a day and let you enjoy the rest of the afternoon. There's probably some football on somewhere, isn't there, over in Qatar. Enjoy the matches if you're watching them, and I look forward to speaking to you at the next of our webinars. Thank you very much for your time. Bye-bye.